Local stories, local voices. We're localwebradio.fm.
Welcome to Sound Investing with Byron Striloff, Senior Investment Advisor at CIBC Wood Gundy, and recognized by Vancouver Magazine in its selection of top wealth makers in Vancouver for 2013. And now, here's your host.
Yes, this is your host, Erik Reynolds, and I'm here with Byron Striloff, Senior Investment Advisor at CIBC Wood Gundy. And today, we'll be continuing our talk with Byron about the spending wave cycle, including how most people project what the stock market will do, and advice for investors to help them have a better investment experience. Now, before Byron joins us, just a reminder that if you have questions or require assistance, you can reach Byron at 604-535-3700. Again, that's 604-535-3700. Now, Byron, as always, it's great to be talking with you again today.
Glad to be here, Erik.
Yeah, so I'm really excited about this new feature with the podcast and the interview that we've got the slides now to accompany us. So let's just go ahead and get straight to it. Let me ask you this. Now, I understand we're going to finish off the spending wave and the move into the human model of forecasting. We left off last week discussing how the spending wave projects an economic upturn. Now, Byron, does it tell us more?
Yes, it tells us a lot more, Erik. And now that we have the slides to refer to, I will quickly try to summarize some of the key points of this spending wave cycle, which should be on everybody's screen right now. If you look at the screen, the blue and red screen, the red background is the birth rates for the United States brought forward by 47 years. So you will see and can see the effect of the baby boom generation on the economy in real time. The blue line represents the Dow Jones stock average. So again, now this allows us to monitor what effect, if any, that as our generation passes through the economy, that it has on it. Now, as you can see, as the red line is going up like a mountain, this represents larger numbers of the generation that are reaching their peak spending and peak productivity. This creates stronger economic earnings, and the stock market reflects that through its performance. So again, if we look at the match, we have a very close match to the level of the baby boomer economic activity and the stock market's performance. So we find that this chart is the best leading indicator to estimate the strength or the weakness of consumer spending and worker productivity, which in turn will give us guidance to project future economic and stock market direction and strength. Now, that's the upside. But another important aspect about this chart is that it also projects the downside. And that's very important to all of us because that's when the market takes away our returns, just like it did in the 70s and the 30s. So in our industry, experts will always tell you to stay invested. And during a correction, they're correct. But during an economic downturn or a longer bear market, no, that's not correct. Today, nothing, as we approach the top of the cycle, nothing could be more important when long-term trends are reversing than to have a downturn strategy in place for your investment portfolios. When the trends are positive, we want to be in equities, but if they turn negative, we want to become a little bit more defensive in our investing. So if we take a look at that blue line, you'll notice there's a first peak and then it comes down, a second peak, it comes down, and then a third peak. So the first peak actually is the 2000 tech correction, the tech crash. The second peak would represent 2008 when the markets crashed recently. And right now we're just moving right back up to where we were at about the year 2000, which would be about 16,000 on the Dow. So we're at the top of the boom. We've had the generational demographic trends of spending and productivity are just peaking right now. And so what that's telling us is that we're moving into a different economy. And I guess one of the bottom lines that I've always said to people, it's not what the Fed does, okay? It's what you or I do. And to the extent that we continue to spend or not spend on products that drive our economy. So the critical insight, I think, that we get from this chart is that when we go into a slower economy, we will need to have a different investment approach and a different asset allocation. So in summary, this information gives me a more dependable method for projecting longer-term economic and stock market direction, and I guess allows me to give advice with a greater sense of confidence.
So let me ask you this question. How do most people project what the stock market will do, and how do we use this information to better understand the risks and returns of changing stock market conditions?
Well, that's always a good question. Markets are always overvalued in cycles of growth and become undervalued in cycles of slowing. And a large part of this overextension is actually caused by people, or more accurately, the psychology of the human model of forecasting. The truth is, every time we get an extended strong boom in the economy or in strong leading sectors like technology, we get substantial overvaluation caused by how people view the markets. And it's human nature to project recent trends in a straight line into the future, whereas the reality of life is that trends move in a cyclical manner. So as a result, we have a serious misperception of reality and risk that causes the vast majority to do the wrong things at the wrong time. And behavioral psychologists will tell you that people are hardwired to be terrible investors. So we tend to think that the longer an investment goes up or outperforms, the more likely it will do so in the future. And conversely, we think the longer it goes down, the more likely it'll do so in the future. So this point of view is dead wrong most of the time and represents the foundation for the oldest principle of successful investing, and that is contrary thinking.
Well, Byron, let me ask you this. What would be a good example of investors misreading a market and as a result doing the wrong thing?
Well, you know what? Perhaps one of the best examples in recent memory would be the tech crash we actually just talked about from 2000 to 2002. Now, that same tendency to project the recent past into the future, that's what causes bubbles to develop near the tops of very strong markets like the one leading into 2000. Bubbles with unrealistic valuations develop to the greatest degree in the strongest sectors during an uptrend in the cycle. And in this case, it was technology. Unfortunately, most buyers or investors begin to buy more and more of the hottest sectors because of the great performance and less of the sectors they may have previously included in their portfolio for diversification of risk. So therefore, they ended up throwing out diversification, which was the single best way of reducing portfolio risk, while they bought more tech for the recent high performance because they perceived this as the best strategy for long returns. So again, as a result, way too many people got themselves into the highest risk positions just before the major correction, so they suffered obviously a much larger loss than if they had not loaded up on technology. And to make things worse, far too many compounded that error by selling out right after the massive losses, which was just in time to miss the stellar returns of the following market rebound. So this is classic emotional behavior that sets the investor up for the most common of all investor experiences, and that's the buy high, sell low experience. So like Warren Buffett has said many times, it won't be the markets that do it investors, it'll be the investors themselves.
Well, Byron, I have more questions to ask, but we're up against a break, so we'll be right back with Byron Striloff, Senior Investment Advisor at CIBC Wood Gundy, and when we return, we'll be discussing how the spending wave works to forecast market conditions. We'll be right back.
more Sound Investing with Byron Striloff after this.
Buying or selling a home on the Semiahmoo Peninsula? Catch up on local market conditions on This Week in Real Estate with Lance and Connie Marples from Sutton West Coast Realty on localwebradio.fm.
If you're struggling with a dental or oral health issue, be sure to catch the Healthy Smiles Oral Health Show with Dr. Norm Ickard on the Health Channel on localwebradio.fm.
Shopping for the lowest mortgage rate? Looking to refinance?
Catch the Mortgage Newscast with Jared Dreyer
On the Business Channel
on localwebradio.fm.
It's now time for more Sound Investing with Byron Striloff, Senior Investment Advisor at CIBC Wood Gundy.
All right, we're back with Byron Striloff, and we're discussing investing and the markets. Now, Byron, could you give us an example of a stock that was a popular investment at the time, but lacked the investment fundamentals to represent good investment value for most people?
Sure. That's actually quite easy, as there's quite a few to pick from. One that comes to mind that I think most people would recognize is Amazon.com at the turn of the year 2000. And that was a good example of this big mistake that I talk about, which is speculating when you think you are investing. The business model of which Amazon was a leader in, which was e-commerce, had itself never made any money. In fact, it hadn't even existed 5 years earlier because the platform it was doing business on, the Internet, it was just being developed. So from the company's point of view, there was no assurance that the company could or would make money, and they actually warned investors about this in their stock prospectus. And in the ensuing tech crash, Amazon did the only thing it could, which was lose over 2/3 of its value. And I can guarantee you that most people who bought it for the red-hot performance did the only thing they could think of and sold it somewhere near the bottom. Now, Amazon did go on and eventually became one of the winners, but still, if you look at the stock charts, it did not surpass its year 2000 stock price until almost 2010. Nortel would be another good example for Canadians, and that unfortunately ended a lot worse because investors ended up losing everything in that case. But in any event, the point is that is how investing morphs into speculating, and the ability for people to distinguish between making investments and speculating becomes critical to their future success.
Now, Byron, that does make sense, as emotions are hard to keep under control. But what advice do you have for investors to help them have a better investment experience?
Well, there's certainly a couple of things that might help out. Since we're so emotional when it comes to our money, and that the nature of the markets is that they move in a cyclical and exponential manner, there's some common sense things we can do to improve our experience. And I would say the first thing is that you want to follow a system. Now, in my case, I use demographics and behavior psychology as my system to keep my emotions and my clients' emotions under control. And it really provides some checks and balances that help to keep emotions out of the equation. Using an objective financial advisor or coach to keep you on that system is always good advice. I don't know of any top-rated athletes, movie stars, or business people who do not hire professional coaching. Learning to think contrarily. It's not easy, but it will stop you from buying most of your investments at high prices and selling them at low prices. You don't want to chase the hottest investments based on performance alone, and you want to understand how the risks and returns of each investment and how they differ in various economic cycles.